All righty. Hey, good morning, everyone. Welcome to today's podcast. Today is Tuesday, the 23rd of August. And as usual, you have the two best, I got to put it this way. If I could just have you guys hear what we were just talking about, I'm going to give you the two best brains in the U.S. Stock market as advisors here today. I'm Kevin Hurley, and I have with me
Michael Verdon.
Michael Verdon. He's amazing. Uh, Notice how we have the little picture today with that brain in there. I love this shot because I think we are literally going to mess with your brain today. We're going to share what keeps us up at night. We're going to share what we're doing, hopefully, to let you sleep at night. And again, I wish I just recorded a little conversation about 5 minutes before we started this. I wish I had some of the things that Michael just told me, and I am going to make him say that today so you can hear what we worry about, what we see in the market, and the reason why, in all honesty, why we're so reluctant to find a place for new money in today's market. In fact, for the majority of this, I'm going to turn this over to Michael to do some talking because I want you to hear literally what we talk about, what we're seeing, and why we're a little too high, why you should invest with Hurley Investments. I love the quote that Michael threw in here. Things can't go on forever. Things that can't go on forever don't. And this is a pretty famous economist, Herbert Stein. Michael, you put this in here. What did you mean by that? Why did you put that quote in here today?
You know, it encapsulates so many things that are going on in the market right now. Everything is kind of expensive right now. Stocks are at all-time highs based on a valuation metric. Treasuries are at all-time highs, meaning yields are at all-time lows. Real estate's blown it out. It's being reinflated. Everything you look at to invest in is near all-time highs. So what do you do with your money? I mean, it's really, look, I don't know about anyone else, but I like to buy low, sell high. That seems like a crazy notion in today's world, but seems like that's what we're supposed to be doing. So how do you go in and you buy stocks near all-time highs? I like to look at fundamentals. I'm a value guy at heart. I'm like the Buffett guys. I like to buy fundamentally sound companies at a reasonable valuation with earnings forecast to grow in time, and I like to get a good deal on things like everyone else. It just seems normal to me. So when things are at all-time highs and you're looking around for a place to put your money in and everything's overpriced from a historical comp, from a valuation standpoint, it's difficult to do. So
Hey, Michael, if I can jump in here, I could tell you, well, look at our S&P. It's up higher. It could be building a base. It could be jumping higher. Probably going to come back lower, and it's a resistance level there. But obviously, you can buy high and just buy that insurance. Unfortunately, and I'm going to say this, I'm going to bite my tongue, and I hope no one shoots me for saying it. Unfortunately, no one likes to see their account go down. No one likes to invest money with a new individual and then see their account start to go down. Now, obviously, with Hurley Investments, it won't go down as much as the market because we put that insurance on, and it makes up some of that downward movement. But I think people sometimes don't understand that we don't make up every penny on the way down. We make up a significant amount, and it kind of goes both ways, though. If you want all the upside, you need to take all the risk, which means you're in jeopardy mathematically at losing over half your portfolio right now. People don't see the risk in the market. In fact, I have a couple of things right here that I've picked up. I'm going to skip the employers offer older workers flexible retirement, but I want to focus on these other two. Here's how the U.S. elections could be more disruptive than a black swan, and then that second one down in the bottom right-hand corner, watch out for valuations when buying dividend stocks, experts warn. Michael he's got 6 or 7 slides here that I want to turn over to him, but in that article of valuations, I printed the first little bit here. I'm going to let Michael also comment on this. The second longest bull market in history has driven stock valuations sky high. High valuations present a challenge for investors concerned about risk. I hope we're all concerned about risk. Should they stick to their plan, change their investment strategy, or sit on the sidelines in cash? A Goldman Sachs analyst, for example, found that the median stock trades in the 99th percentile of its historical valuation. To put that in simple plain English, stocks have never been higher in price with more risk to the downside except for 1%. 1% of the time they were a little bit higher, and I'm sure that goes back to probably the Great Depression or something like that. But plain and simple, one more time to say it to you, I'm going to turn the mic over to Michael. Stocks have never been more expensive or more ripe to lose significant amounts of value than right now today on August 23rd, 2016. Never in the history of the market have stocks been so overpriced than they are this morning. Michael, jump in so I don't sound like Dr. Doom here.
No, you know what? You're exactly right. And I kind of think sometimes maybe we do sound like Dr. Doom or whatnot. And we are, Kevin, I've known you for years. We are just not that way. But I think maybe that's what people think. I think people, maybe our perception is that we're just always about doomsday and this and that. And that's so not the truth. There's a quote that Lloyd Blankfein, who's the CEO of Goldman Sachs, speaking of Goldman Sachs, said once upon a time, and I'll never forget it because it encapsulates exactly what we do. He said he spends 98% of his time thinking about the 2% probabilities. So what he's saying is he spends all of his time thinking about things that are going to destroy these portfolios for his clients. Because I love to say that everyone makes money when the market's going up, but no one's making any money when the market's going down. And that's what we try to do. Because what we're selling is we're selling peace of mind, as it turns out. I mean, we make as much money as we can when the market's going up, and we protect client assets when it's going down. We lower cost bases and add shares. I mean, I'm sure probably most people listening to this are familiar with that concept. So this 99% valuation, we were talking about it before this podcast. That means from a valuation, a comp stocks have basically never been higher. So we try to buy low, sell high, right? Well, you know, we're pretty high right now. So what do we got next here?
Let me go through some of the slides. I want you to walk us through what you see and what we talk about.
I'm a little reluctant to do this, as we were saying, because you know what, I'm going to do this as quickly as possible, but this is the short story, and this is kind of how we got in the shape that we're in, because people are like, hey man, look, the market's at all-time highs. What's wrong with you? Things are fantastic. So when things are great, that's really when you ought to be looking around. It's just like in 2000, before the dot-com bust. I remember talking to people. I had little knowledge about the market, but I remember telling people, look, these companies that are worth billions of dollars, they don't make any money at all. That just doesn't even make sense. And then before '08, we were out of the market. We were well aware of what was coming. Fed raised rates, I don't even remember, 13, 14 times. You knew that houses were going to crash and come down. We knew it. But people don't want to hear these things. I don't know why. It's like, my father just got back from the doctor a few weeks ago. He's in great shape. He's worked out all his life and run, and he's in excellent condition. But the doctor told him, he said, look, man, if you don't stop eating sugar, in 2 years you're going to be a diabetic. And he's finally going to do something about it. So the point is I don't understand why people need to change their behavior. They always wait till it's too late. And it's the same in the market. So real quickly.
Hey, Mike, I'm going to interrupt you. It's human nature. You know what it is? We can fight it. We can beat it. We're Superman. It's kind of immature in all honesty. But I do think it's human nature that, you know what, we can beat it. We got this beat. And I tell you, it wasn't until my dad got cancer and to see him crying with my mom to realize that, you know what, there's some things you're not going to win in life. Life isn't fair. And for my dad to get cancer the way he did and the fight that he's fighting, there are some things you're not going to beat. Cancer is one of them, in all honesty. Um, I sometimes look at how people view risk in the stock market, and it's simple. It's mathematical. You can understand they're not going to beat the stock market, but I don't think people have the understanding of why they can't beat it. So give it to us today. Show us. We got some great charts here. I want you to go through why we're not going to beat the stock market.
Okay, just real quick, let's just blow through these. So we're in the condition we're in now. So how did we get to where we are, right? So stocks are at all-time valuations because yields on treasuries are so low, and really this Keynes principle you hear about, there is no alternative. So here's what happens: the U.S. government spends money like it's just going out of style. So we're coming into election cycle. So what's going to happen is whoever promises the most people the most stuff wins. So there's going to be which creates a deficit because we don't have the tax revenue to pay for all these entitlements. So it doesn't matter which side of the aisle you're on. This is not a political statement. Bush doubled the debt. The previous administration or the current administration's doubled the debt. And I don't think either of our choices are going to do anything different. So there's this yearly deficit. So Congress goes to the Treasury. They say, hey, we need some more money. They sell these bonds in the open market. And so it creates this huge debt up to 19 trillion now. So what do we have next year, Kevin?
This one, I think we're going to be at like 21 trillion.
Yeah, I just thought this was funny because if you look at what happened in the dot-com bust in 2000, people stopped spending money. This is the velocity of money. People's behavior changed. So people have been spending less since 2000. So the government's ramped up and they're spending more. To the next slide, please, sir. So here is the federal debt. This is not even an off-balance sheet. This is public-private debt. This does not include Social Security, Medicaid, Medicare, and other programs. So you're that the world as we know it is going to come to an end soon, but the big question is when, right? So here's what's gone on. Since 1981, when Mr. Paul Volcker, uh, the Fed president back in the day, tried to lower inflation, and what did he do? He raised rates a lot. So in 1981, I think the 10-year got up to over 15%, 15.81 or so. So what's been going on is this entire time, rates have been dropping from over 15% now to we're at 1.5% today. So what that means is interest rates trade inverse to the price. So prices of treasuries have been going up the whole time. So when you heard about QE, this quantitative easing back in the day when Ben Bernanke instituted this. So what this basically is they're buying, well, a lot of it's buying the toxic debt off the banks to bail them out, but an ancillary effect is they're buying up huge portions of the float of treasuries to continue to drive the price higher. So this yield on debt continues to drop. They would do that to spur spending, lower the cost of housing, and just the interest expense you pay. So
Hey,
I'm not
Mike, if
sure.
I could jump in right here.
Sure.
Um, it's kind of funny because, how do I say this? As registered investment advisors, we get paid on people's money. In fact, just like an annuity, uh, putting people into bonds or bonds funds, we get paid a significant amount of money up front to be able to do this. And as I look at this chart and I kind of think about how messed up the whole financial planning scene is, as you get older, more and more of your money should be transferred over to a quote unquote safer investment, a bond fund of some kind. Excuse me. No mention is said about how much money we make to put you in it. And I'm clearly looking at it and saying, hey, you know, the average bond used to produce a 4.5 to a 5 to a 6.5%. Well, we haven't seen that since 96, it looks like on this chart. So here we are, you know, traditional quote unquote advisory services are sticking people into a lower yielding asset based on a historical model that says it actually is going to yield higher when it doesn't. And the only one that's winning is the dummy that's putting him into it that gets paid a huge commission up front. I can't believe people still look to the traditional method, the big box houses, the Charles Schwabs, the Goldman Sachs, to manage their money when this is what's happening right here in front of them. It's easy to see.
If you could go back to that chart real quick, if you don't mind, there's so many tangential conversations you could have from just that alone. I mean, it irks me somewhat. Look, I'm apolitical as much as I can be, but you know, I hear this previous administration coming out talking all the time about how great they are because look, they've lowered the deficits and on and on and on. It has nothing to do with they're spending more money than ever. It has to do with the interest expense they pay on the debt. If you go back to when this current administration was elected, go back to those yields that they had to the interest that they had to pay on our debt. If you do that, you'll see that we would have deficits, yearly deficits over $1 trillion every single year. So what's going on is they're spending more money, but they keep lowering the interest rate. It's like, look, you and I, if we keep blowing up our credit cards but keep lowering the interest on it, we can continue to spend the same. So that's going to end when we basically get closer to the zero bound. I know there's a lot of places in the world right now that have negative yields, but we're basically the last, line in that sand where they can continue to lower these rates up until, theoretically zero. And maybe this dynamic can go on for quite some time. And I know that that's their intention. Um, so the notion that, how do you know, and I've been telling people this for years, and I used to think I was maybe a little off base. How do you know that the Fed can't raise rates or they're not going to raise rates? Because they can't. So to get to those slides that you're about to, these little spreadsheets, this is just a real quick example of why the Fed can't raise rates. Look, so what happens is, I haven't checked in some time, but I think maybe, there's always these auctions of Treasury debt, and so they roll in all the time. I think maybe it'd take 4.5, 5 years to roll all the debt to whatever the current interest rate is. So look, right now, the national debt, if you go to the top, is 19 trillion, for instance. This highlighted area in the bottom. So if the yield's 2% on the 10-year, that's the interest, how much you have to pay on this debt. That equates to almost a $400 billion a year interest expense. So they don't want to raise rates because you know what you get, Kevin, when you have to pay higher interest?
What, you get a higher amount you got to pay out in debt?
Yeah, you get nothing. You pay more for the same thing. This is money that's already spent, so when you have to pay more for what you've already spent, it takes out productive capital. So if you go to the next slide real quick, you'll see that instead of 2%, so let's say that the Fed raises rates. They act like they really want to raise rates because that's healthy for the economy. But the problem is, with 20 trillion in debt, we don't live in the world we used to because now we have this huge debt load we have to pay. So if rates just go to 4%, that's $760 billion a year. You go to the right, that's 35% of all taxable tax revenue the government's going to take in. If you go one more slide, so if you go back to the historic norm and say 6 or 7%, well, look, 6% yield on the 10-year, that's going to be over $1 trillion a year in interest expense that we have to pay out. It's over half of the total tax revenue. So, of course, they're not going to raise rates. I mean, where's this money coming from? Look, we just print money, or, well, more specifically, create bonds and sell them into the open market so the Treasury can give this money back to the government to pay for all these, whatever their pet project is of the day. They're not gonna raise rates on themselves. We are so far down this hole, they can't do it. And it's a scary thing. So I know that they come out and they've been saying, yeah, we're gonna raise rates, but we don't live in the world we used to anymore. So It's real simple. Look, we can't. They're not going to raise rates because they can't. And with the debt load we have, it's a scary place. So you know what? What goes on past 0% interest rates is another story. Which one? It gets a little. People start looking at you funny. So I don't really want to go there. But the point is you know what? Both of our presidential candidates, both of them they're going to expand spending, and they're not going to be able to raise rates. So what does that mean? That's why. I mean, as to the beginning of our presentation, why the stock market's at all-time highs and why these dividend payers are just going through the roof. Because you know what? When you got a bunch of money and you have to create a yield to live on, where do you go? What are you going to give your money to the government for 10 years for 1.5%? No. The only place you can go is something that it pays you a yield, which is these high dividend paying stocks, which in a world of ever lower yields, that's the only place you can go. And so the historic safe place to put your money in the market, these div payers, has become now one of the riskiest places to be. So
Hey,
now
well,
more than ever.
I was gonna say I appreciate you bringing this to the forefront. I always wondered why on just a quarter point raise that we had, what, end of last year, we watched our markets fall 10%. I think your numbers just justify that. I think the market saw just a quarter% raise and went, oh my gosh, look at the huge increase in the interest on the debt load that we have from just a quarter%. Guys, excuse me, I'm coughing again. I appreciate you being here. I hope you hear a little bit about what we have. Michael, did you want to finish your thought that I interrupted you on there?
No, no, no. I was just going to say, historically, I think, to your point about raising rates, whenever the Fed has started a tightening cycle, they continue on until whatever bubble's going on burst. And make no mistake, everything is overpriced. There's bubbles being blown everywhere. And to kind of cross this T here in the end, it's kind of the biggest bubble that's ever been blown is this bond bubble. And all central banks are doing it. All policymakers are all looking to their central banks to fix the structural problems going on in their economy. And the only way a central bank can do it is just buying bonds and lower rates and messing with the interest rate. So this interest rate interventionism with this bond buying programs going on, it's a crazy, scary world right now, and I don't think people really realize what's going on and why prices are so much higher in the market. It's not because everything's great in the world. I mean, they're buying bonds. Look, we've been at near 0% interest rate yields, ZERP policies for almost a decade now. So, I mean, that's not because things are so great. If things were great, interest rates would be higher. So, anyway, it's a scary world. So, and the market can be a scary place. And so, Kevin, we just do the best we can to guide our clients through some scary times.
So if you ever want to hang out with us over a Merlot or a pitcher of beer, this is the conversation you're going to get. This is what we spend our time talking about, day after day, year after year. Well, again, we just want you to know, hey, we see what we see, and we're doing the best we can to make sure that we can protect you from the next black swan, whether it be an interest rate hike, whether it be a presidential election. Just know that we're here to do the best we can to make sure that as markets fall down, you are protected. We can make up as much of that downward movement as possible. Michael, I appreciate you being with us here today. Guys, thank you for listening. We hope you enjoy this. Any questions, our toll-free number is down there, or you can email us. We look forward to hearing from you in the near future, and we'll talk to you soon. Bye-bye.